If you've ever wondered how Warren Buffett became one of the richest investors in the world without chasing trends or checking stock prices every 5 minutes, you're not alone. Today, I want to break down Warren Buffett's simple three-step investment strategy. No complicated charts, no fancy Wall Street jargon, just a clear, practical approach that everyday investors can understand and actually use. This is Money Mastery Insights, so let's get into it. Step 1. Invest in what you understand. Warren Buffett has a famous rule. Never invest in a business you cannot understand. And this is where most people go wrong. Buffett doesn't invest in companies just because they're popular or hot. He invests in businesses he can easily explain in plain English. What does that mean in real life? Think about companies like Coca-Cola, Apple, American Express. These are businesses with simple, clear models. They sell products people use every day. They have strong brand loyalty. They make money in predictable ways. Buffett avoids companies where the business model is confusing, overly technical, or constantly changing. If you can't explain how a company makes money to a friend in 1 minute, Buffett would probably pass. Step 2. Look for strong, high-quality businesses. Once Buffett understands a business, the next step is quality. He looks for companies with what he calls a competitive advantage, often referred to as a moat. What's a moat? Just like a castle has a moat to protect it, a great business has something that protects it from competitors. Examples include strong brand names like Apple or Nike, customer loyalty, high switching costs, unique products or services. These companies don't just survive, they dominate. Simple example. Imagine two coffee shops. One is a random local shop. The other is Starbucks. Starbucks has brand recognition, customer loyalty, and scale. That's a moat. Buffett wants businesses that are built to last for decades, not just a few good years. Buffett doesn't buy okay companies at cheap prices. He buys great companies with staying power. Step 3. Buy at a reasonable price and hold long term. This is where patience comes in. And patience is Buffett's superpower. Buffett doesn't rush. He waits until a great business is selling at a reasonable or discounted price. Not necessarily the cheapest stock, but a fair price for a high-quality company. Then comes the most important part. He holds for a long time. Buffett has said, "Our favorite holding period is forever." He lets the business grow, profits compound, time do the heavy lifting. No panic selling. No emotional decisions. No jumping in and out of the market. Buffett makes money not by trading often, but by holding great businesses and letting compounding work. Putting it all together, so Warren Buffett's three-step investment strategy looks like this. Understand the business. Choose high-quality companies with a moat, buy at a reasonable price, and hold long-term. That's it. Simple, but not easy. Because it requires discipline, patience, ignoring hype and noise. But history shows that this approach works again and again. Closing, call to action. If you're serious about building long-term wealth, Buffett's strategy is a powerful place to start. You don't need to be a financial genius. You just need to think long-term and stay consistent. If you enjoyed this breakdown, make sure to subscribe, and follow Money Mastery Insights for more simple, smart investing content. Thanks for watching, and I'll see you in the next one.